Hello and welcome to the 5th video of the Risk Blueprint. So today we'll talk about risk governance and reporting with 3 topics as usual. We'll start with the definition of roles and responsibilities of the 3 lines according to the Basel committees. We'll see the main content of risk reporting and finally features of insightful reports. So, if you remember our first episode dedicated to the maturity of a risk management framework, we covered 3 signs of healthy governance: clear roles and responsibilities, effective training, and done at the top, meaning leading by example from management. Now, regarding the roles and responsibilities, I can only advise you to consult the revision for the principle of the sound management of operational risk published in March 2021 by the Basel Committee. It's the 5th edition of the banking regulator regarding what they expect in terms of operational risk management, and it is, in my view, the most mature publications. The 3 lines of defense are clearly assigned across the business management units, so the so-called first line, the core function, so the corporate operational risk management, which is the second line, and internal audit, the 3rd line. Now, in this document, the roles and responsibilities of each of the 3 lines are clearly defined, and I'll come with more details in a minute. But consider the first line, who can also be called the risk owners, the front line of risk management. That's where risk is identified, assessed, mitigated, and reported. The second line, which confusedly is called the risk management function, is actually more a risk methodology function. The second line is the guardian of the methodology, the framework, and they have a big role in training the rest of the business in what good risk management looks like. And finally, once everybody is trained and can operate risk management in a proper way, comes the role of oversight and challenge of the second line. And finally, the 3rd line is internal audit with a classic role of independence review and assurance. Now, if you want more details about what these roles entail, again, I refer you to the document of the Basel Committee. We've done a number of assignments regarding the risk governance, and it is a topic that most firms still struggle with. So here you have highlighted the key roles of the first line of the business or the risk owners when it comes to risk management. First one is to identify and assess the materiality of operational risk. Note that the Basel Committee mentioned key operational risk, material operational risk. Risk management doesn't need to focus on minor risk. We talked in previous videos about risk assessment. Don't worry too much about the small inherent risk. Use proportionate risk management, focus on your material risk and your key controls, appropriate controls, and also in the 3rd topic, the importance of reporting any sorts of gaps and any sorts of needs for more tools, more resources, or more training when it comes to risk management. And then the typical step of monitoring and reporting about the operational risk profile. The second line has to develop an independent view regarding the business unit, materiality of operational risk, effectiveness of key controls, which is in a sort of way, say, synonymous to effective risk management, and the development and the compliance to risk appetite and tolerance. And then comes the challenging role of the second line to the first line if they judge that these risk management activities and effectiveness can be improved. Alongside the training role and the challenging role, the risk function, the second line, has a clear role of developing the measurement, management, policies, standards, and guidelines to the rest of the organization and deliver training. Maintaining risk awareness and risk culture is a role for the 3 lines, all 3 lines. Now, focusing more on risk element, what do you typically expect from a risk reporting pack? Well, obviously what has happened, so there will be a write-up of incidents and near misses. More importantly, what are the lessons learned from these incidents and near misses, i.e., do we need to develop action plans? Does the organization have to change something with regards to its risk management or key controls? And just as importantly, because we talk about governance, the deadlines, the follow-up, and the follow-up on the completion on time of these action plans. Typically, of course, the risk appetite and, more importantly, the monitoring of the key risk indicators that support risk appetite. I refer you here again to a previous videos for more detail about risk appetite structuring and monitoring. And then finally, or at first, there's no particular order here in this table, the top risks of the organization, usually 10. Why 10? Because it's more conventional than really risk-based, and an element of what are the risks in the horizon with emerging risks or horizon scanning. You can have, this is the minimum, but you can have additional elements to your risk reporting, such as results of RCSAs, control gaps, regulatory findings, etc. But at the core minimum, these are basically the elements you expect. Now, importantly, you want your reporting to bring values. You don't want some paper production that no one is really inclined to read. And in order to have valuable reporting, I would advise you again to look at 3 features. Insightful. Insightful meaning focusing also on deviations, and this is a topic I will come back to, and unusual elements, and keep it short and simple to be understood. Engaging, and that also means adapting your different risk reporting to your different audience. You don't report the same to the board as you report to risk management department or to risk business or to business departments. And finally, you also want to be inspiring. We'll have a full videos dedicated to positive risk management, but you don't want your risk reporting to only be the bearer of bad news. I would really encourage you to report success and positive outliers as well. A little bit more specificities when on the engaging part. Ask first, before reporting, ask your audience what they expected to see, what's important to them. Now, again, decades of experience in risk management has taught me that boards and executives really worried about the key risks that would end a business. And that would also could jeopardize their mandate if something very significant happens to the firm, because they have a personal responsibility in the continuity of the firm. So that naturally they care about that. Division heads, department head really care about the status of their business, but they're also very interested in how their performance compared to their peers. So I would encourage you to have comparative reporting so Department A can compare itself to Department B. Again, experience shows, and the firms I work with and others, that it really helps engaging your audience. And then I've done a lot of reporting redesign in my life, and my core question is, what are you trying to say? A lot of reporting, risk and otherwise, have the weakness often not to have a salient message, not to have the more important message that comes first. So I would encourage you, when you review your risk reporting pack, to really ask yourself, what is the key message I want to get across? Or what is the decision I want to be taken, especially if you report to management? And then just as importantly, does it come out clearly in my message? And so just another example coming from the industry. The name is mine, but the practice is very common in Tier 1 bank, is the slicing of reporting. And so I explained that in a tiered cake, when you have at the basis no difference between monitoring and reporting. In the reporting is all you need to know to monitor, and that would be the pack that typically goes to the risk management function and to the operations level of the divisions. Once you go one level up to senior management divisions heads, it's all you need to know to act, because reporting needs to drive actions. And then at senior management level, executive level, board level, it's all you need to know to decide, because that's where the decisions lies. And it's a principle-based rule of thumb, but it might help you slicing down the information as you go up the organization. And so I'll finish with 3 golden rules of reporting, which is in a way 3 different ways of saying the same thing. Make sure you report elements when the value of information exceeds its cost of collection. And what drives the value of information you use is precisely that, is when you know how you're going to use the information. So once you report KRIs, risk near misses, how you're going to act on this information, even if the action is the reinforcement of the status quo, doesn't necessarily need to have a change in behavior. And then finally, and nuancing that, is if the reporting influences decision making. Now, I have to caveat these rules, though, because there's a number of regulatory reports that may not feel valuable to the firms and yet are mandatory. So see it as a tax on the business, or trying to have the positive approach of reflecting on how you can squeeze values and decision-making out of your regulatory report as well. We'd love to share some examples of good practice with you, so please reach out for a chat and personalized advice.